A quick note before we get started in the video. If you are interested in purchasing the SPX Daily Key Levels V 3.0 indicator, you can email us at daytradinggps@gmail.com to request a discount promo code to purchase lifetime access to the indicator. To purchase the indicator, go to daytradinggps.com. Hello, in today's session, we'll be taking a look at the Wednesday, May 6, 2026 trading session for the CBOE SPX index. We'll be utilizing three different indicators from Day Trading GPS. The main indicator is the SPX Daily Key Levels V 3.0 indicator, and then two add-on indicators. One is the VWAP for SPX CBOE, and the other one is the ribbon indicator with an optional filter for US indexes such as SPX, NDX, Dow Jones, and Russell 2000 index. Okay, to start off, we're going to take a look at the VWAP. So some of you may already be familiar with this situation on TradingView if you already trade SPX CBOE, and that is that the SPX CBOE Global Indices feed, which gives you the SPX CBOE index, which is the official CBOE SPX index that everyone follows, as well as the mini SPX index, the XSP, does not provide volume data to TradingView. So consequently, as a result of that, it's not a TradingView bug or a TradingView problem. It's simply that CBOE Global Indices data feed does not provide volume data. So if you try to use the standard VWAPs on the TradingView platform, either the VWAP here or the VWAP auto anchored, which is the VWAP AA, you will typically see these red exclamation points, which stand for no volume data. So since there's no volume data, consequently there's no VWAP that works on SPX CBOE or XSP mini SPX index. So if we turn off our VWAP here, you will see the VWAP has disappeared, and that's because the native VWAPs do not work on TradingView, do not do anything that TradingView does or doesn't do, but simply because the global indices feed that TradingView gets from CBOE global indices does not provide the volume data, so therefore there's no VWAP. However, our day trading GPS VWAP for SPX CBOE, which also works on XSP as well, does provide the VWAP on these charts, and that is because it uses an external data source for either the XSP or the CBOE SPX. So with this add-on indicator, you can now have VWAP directly on your CBOE SPX chart or your XSP CBOE chart instead of having to open up a second chart which either would have ES futures or would have a Forex CFD as an example. So this keeps everything on one chart for a much better perspective, and also this does include the institutional volume as well in it, so that is one advantage over using perhaps a second chart with a Forex based version CFD of SPX, because that is only going to give you the volume on through the Forex broker for that particular CFD. It's not giving you the true volume on the official SPX CBOE index. Also, our day trading GPS ribbon indicator is different in that it does provide a filter for US indices. So on this particular indicator here, you have a filter that can be enabled for US indices. It also works not only on the SPX CBOE, but also the XSP mini index, as well as the NASDAQ index, Russell 2000 index, and Dow Jones index. So it can also work for those indices for people that like to trade the other indice options on the other indices, either the NASDAQ, the Russell 2000, or the Dow Jones. The advantage of this particular ribbon indicator is that you can do a dual screen. as opposed to just having one screen. So with this particular ribbon indicator for indices, you can do a dual screen, one with the filter on and one with the filter off. And if you prefer to have dual confirmation on your bullish or bearish entries, you can use both ribbons, one with the filter on and one with the filter off, to have confluence with both ribbons if you prefer that over just using a single ribbon with either the filter on or filter off. So we'll show you that setup now. Okay, so here we have with the filter on the left side and with the filter off on the right side. So as you can see with a normal ribbon indicator, you are going to get on gap up and gap down days, which SPX and most indexes have gaps on most days. However, when the gap is sort of a medium to large or extreme gap, then you can get sort of an aberrated view with no filter on. And that can lead to decisions that may not be correct for situations where, especially if you have a reversal off the gap immediately, whereas this is because of this aberration here with no filter, is still going to show a ribbon in one color or mostly one color due to the aberration from the gap versus the reset, which is going to give you a more accurate picture of what is actually going on from the open. In this case, what we're trying to get by using a dual screen is not only seeing both and then making a judgment for ourselves based on either a close above or close below a main key level or a contextual level, but also if we want to use dual confirmation, then we're looking for both ribbons to be in confluence with each other at the time of the close above or close below the key level. So close above for a bullish entry, close above a key level, or a candle close below for a bearish entry. So what you're looking for here is you're looking for the ribbon to be all the same color, and ideally you'd like for in a bullish entry for the top part of the ribbon to be starting to pull away as opposed to being completely compressed, and for the ribbon to be all one color to confirm the entry. In the reverse, on a bearish entry, you're looking for the ribbon to be all red as opposed to multicolored, and ideally on a bearish entry on a close below a key level, you are ideally looking for the bottom part of an all red ribbon to be starting to pull away from the base. Okay, so in today's video, we're not going to go through every aspect of how this indicator works. We're going to run through the trades and the two different trading strategies. One is the standard key levels options trading strategy, and the three different strikes that are available for that under the standard daily key levels trading strategy for either bullish or bearish entries off of any main key level or contextual level. And then we're also going to take a look at our new early session lotto option strategy, which is for two additional levels. And what are some of the advantages of the early session lotto option strategy that you can consider over using the standard key levels option strategy? Okay, so right now we'll go ahead and turn these off. Okay, so as we saw in the previous dual screen look, we'll just go back to that for just a second. The opening candle here actually does not close above the bull bear key price level. So this opening candle closes actually slightly below the bull bear key price level. So if we turn on the bull bear key price level alert for the 9:30 a.m. opening candle, you will see here that it's giving a bearish signal off of that because it does close, even though it's kind of hard to tell here, it does close slightly below the bull bear key price level. So what the ribbon is doing in this case is it's keeping you out of this potential bearish trade here on the close below because we do not have confluence with the ribbon on this close below signal here on the opening candle. So what you're then looking for is, since this is going to be negated, then you're looking for the next trade opportunity, which in this case is going to be the very next candle, which is going to be the 9:32 a.m. candle. Now you also could do the 9:34 a.m. candle as well if you happen to miss this one, and you also have these candles here. So these candles here that follow, starting with the 9:32 a.m. candle, are giving confluence not only from a close above the bull bear key price level, but also that the ribbon is green on both ribbons, filter on and filter off. So if you're using dual confirmation split screen, you're getting confirmation from both ribbons on this close above. You also have this close above here, and also these close aboves that happen over here as well. Even this candle here, which is a red candle, still closes above after wicking below. Now on the 9:32 a.m. candle, so we have a bullish entry here. The bull bear key price level for the day 7309.38. So the standard key levels option strategy, as you may have seen in our previous videos, but we'll briefly explain it for those who have not seen our previous SPX videos, is that you have three different option strikes that you can consider on any bullish or bearish trade from a main key level. The main key levels are the bull bear key price level, the R levels above, the main R levels above, meaning the R1 through R6, and the main S levels below, the S1 through S6. Also, the contextual levels are the PML, the PMH, the YDH, the YDC, and the YDL. YDH, YDC, and YDL are yesterday's daily high in the RTH session, yesterday's daily close in the RTH session, yesterday's daily low in the RTH session. The PML and PMH are the pre-market high and low in today's current session. Now, how you figure the three different option strikes are as follows. In this case, the trade is off the bull bear key price level, the bull bear KPL. That is the level that we're basing the trade on. It is a bullish trade. And so in this case, the closest strike to the 7309.38 level is going to be the 7310 SPX option strike. That is the standard play in the regular option strategy for the key levels. The two other ones that are in the standard option strategy as opposed to the lotto options are going to be as follows. You look to the first midpoint above the level that you're the main level that you're taking the bullish trade from. The first midpoint above is this mid BBKPLR1 7317.82. So the second alternative strike is going to be the closest to that level. That's the 7320. The third and final one that you can consider using these standard daily key levels strategy is going to be one full key level away in the direction of the trade. So in this case, since it's from the bull bear key price level, one full level away is R1 in the direction of this bullish trade. So that's 73.26.25. So that excuse me, that is the 73.25 option strike. As you can see here, we have all three of these strikes here with the ask price for the 9:32 a.m. candle close. We're on a 2-minute chart. If you've seen our other videos on SPX, the 2-minute chart is the recommended chart time frame for the daily key levels trading strategy on SPX. You can also trade within 1 minute to 5 minute if you prefer a different strategy, as you are still confirming your entries with the ribbon indicator. So you can use uh, 1 minute up to 5 minute chart time frames. You're still going to be confirming your closes above and closes below with the ribbon indicator on those. However, the recommended chart time frame within the 1 minute to 5 minute range is the 2 minute. However, if you prefer a different chart time frame between 1 minute and 5 minute for other reasons, you may be using other indicators that help you in your trading that you like on a different time frame, you can certainly do that as well, as you're still going to be confirming your bullish or bearish entries with the ribbon indicator. Okay, so on this trading strategy with this particular indicator, there are two different types of trades that you can take. One is a scalp only trade. The other is called a regular day trade. So a scalp only trade, you are looking for a one level move in your favor. The one level move is calculated from the level that you're basing the trade on. In this case, that's the bull bear KPL level. You're going to look in the direction of the trade that's up. Since this is a bullish trade, one full key level away is the R1. So R1 is your scalp only exit. The scalp only exit, you're exiting 100% of your position, regardless of how many contracts that you have, whether you're trading one contract, two contracts, three contracts, 5, 10, 20, or what have you. On a scalp only exit, you're looking for a quick in and out. And in this case, the scalp only exit is at R1, and that hits at 10:24 a.m. Now let's talk about stop losses. Stop losses with this indicator on main key levels being the bull bear KPL, the R levels, and then the S levels, is done with the QL levels and the midpoint levels. Stop losses with the contextual levels are done through the user control panel in the section for taking bullish and bearish trades off of those levels. So you simply go down to that stop loss and take profit levels for PML, PMH, YDL, YDH, and YDC. And it starts off with a bullish entry section, and that is followed by a bearish trade entry section. And in there you have separated by bullish and bearish entries in different sections. It goes through each one of the contextual levels in which you can choose either a standard or tight stop loss to use. And then you have a risk reward multiplier that you can also enable. So both of those will be printed with lines with line labels. The risk reward multiplier, the default is going to be 2, so that's $2 of reward for each dollar of risk. The risk is defined as the amount of space between the level that you're basing the trade on and the stop loss, or the reward is going to be 2 times that amount, whether you're using the standard or the tight stop loss. The risk reward multiplier will go down. You can set it at a less value than 2 in 0.25 increments, going all the way down to 0.25, or you can go above in 0.25 increments all the way up to 30. Now you can also use other key levels for your contextual trades if you don't want to use the reward risk multiplier. We show how to do that in some of our other videos. If you want to email us at daytradinggps@gmail.com, we can point you to the specific videos in which we go over how to do that on these contextual levels if you don't want to use the built-in reward risk multiplier and instead want to use the other key levels for your exits on those trades. But in today's session, we're basing a trade off the bull bear key price levels. So in this case, the scalp exit is going to be R1 on this bullish trade from this level. The tight stop loss for this trade is going to be the QL level below the level that we're basing the trade on. In this case, that's QL below BBKPL, since we're basing the bullish trade on the bull bear KPL. If this was instead a bearish trade, then it would be the QL above the bull bear KPL. The standard stop loss is going to be the first midpoint level below the level that you're basing the bullish trade on. In this case, mid BBKPLS1. If this was instead a bearish trade, it would be the exact opposite, the first midpoint above the level that you're taking the bearish trade from. And it works the same off the other main key levels. You simply can go into the user control panel and turn on, you can either turn them on in advance if you want. We don't have them turned on for today because the default ones are these here. You can simply turn on any midpoint level or any QL level above and below any main key level or the bull bear key price level here. The QL levels are just turned on by default for the above and below the BBKPL, but you can turn them on for other levels here should you choose to look at bullish or bearish trades off of other main key levels, either R or S levels during the remainder of the session. Now the difference between the standard SL and the tight SL, the tight SL is going to be stopped out more often than the standard SL. So the standard SL is the recommended SL to use on trades. However, every trader is different. Every trader's risk profile is different. And so you have both to choose from. Which one works best for you is simply a process of going through utilizing the indicator either on a demo trade basis to begin with till you find your exact process and which stop loss you prefer using over time, and then you can start using either the standard or the tight based on how you like to trade and whether you don't mind getting stopped out more often with the tight stop loss as opposed to using the standard stop loss. In this particular trade, neither stop loss was hit on this. It came a little close here on this wick down for the tight stop loss, but in this case, neither stop loss was hit. Okay, so here we have the entry prices on the ask of the 9:32 a.m. candle close. The 73.10 is $14.50. The 73.20, $9.50, and the 73.25, $7.50. So in this case, each option, if you took the 73.10, is going to cost you $1,450. Each option here on the 73.20 is going to cost you $950. And each option here on the 73.25 is going to cost you $750. Now, as we noted here on the 10:24 a.m. candle, you have a hit of the R1 level. That is your scalp-only exit. Here on the scalp-only exit, we have a bid on the candle close of the 10:24 a.m. candle on the 73.10s of $23.10. So that is just under $900 profit per option. On the 73.20s, we have a bid of $15.70 on the candle close. So that is just over $600 profit per option. Then on the 10:24 a.m. candle for the 73.25s on the bid, $12.50. So that is $500 profit per option on that scalp. Now, as you mentioned, there is a regular day trade that differs from the scalp trade in a couple of different respects. One is that you have a different target. The minimum target threshold on a regular day trade is going to be a 1.5 level move in your favor. The alternative target is a 2-level minimum ideal move in your favor. The reason why a 2-level target is called the minimum ideal target is because in 80% or so of the sessions in a normal year and normal volatility environment for SPX, a 2-level extension above or below the bull bear KPL in any given session, and about 80% of the sessions in a normal year and normal volatility is going to be the extent of a move. In some cases, you will get a 2-level extension above. Other cases on bearish days, 2-level extension below. And then on days where we have more of a market that has a little bit more volatility, you'll see 2-level extension moves in both directions. However, 80% of the time, as stated, the price action is going to be contained within R2 down to S2. On the remaining 20% of the sessions, you're either going to see compressed volatility sessions that will struggle to get outside of R1 to S1. And then the other part of the remaining 20% sessions are going to be sessions in which you will have more wild volatility and extended moves that will go above R3 or below S3. Okay, so here on the 10:34 a.m. candle, we have a hit of the mid R1, R2 level. That is a 1.5 level move in your favor. That is the minimum required threshold for a regular day trade as opposed to a scalp. Now, with a regular day trade, you have several different options as to how to handle that versus in the scalp, we were just exiting 100% once we had the one level move in our favor. On a regular day trade at either the 1.5 level move or 2 level move in our favor, we have several different options available to us. So one is going to be doing the same thing you did with a scalp only trade, and that is exiting 100% of your original position. So that's pretty black and white. You're simply exiting with a greater amount of profit because we've moved to a further level in our favor than the scalp. The second option that you have is to adjust your stop loss to break even or break even plus a minimum profit buffer of, at the beginning, 10 to 15% generally on top of break even. So what does that mean, moving your stop to break even? Well, what it does not mean is moving your stop to the entry that the SPX entry was executed at. Nor does it mean moving your stop to the bull bear key price level, the level that the trade was based on. What it does mean is moving your stop loss to a price of the option that you bought. So you're moving it to break even means moving it to the price that you paid for the option. So in this case, $14.50. In this case, with the 73.20, $9.50. And in this case, with the 73.25, $7.50. So to begin with, your initial entry stop loss is based on levels. Tight stop loss level or a standard stop loss level based on either a QL level or a midpoint level. However, when doing an adjustment on a regular trade at the threshold level, you are then changing to the break-even price for the amount that you paid for the option, or adding an additional profit buffer of, say, an additional 10% to 15% at the most at the beginning. So a 10%, for example, on this $14.50 would be approximately $1.50. It's easiest just to kind of round up or round down. When you're adjusting your stop loss, you don't really want to take a lot of time trying to figure it out to the nth degree. It's best for speed of execution just to have the 10 to 15% zone, pick a number, round up or round down to make a quick calculation, and then execute your stop loss. Obviously, if you're going to be changing it to break even, that's simple enough. You're simply changing it to the price that your entry was executed at. So for example, if you were taking this $14.50 entry here, you're adding 10%, that's approximately $1.50. And then so that would make it $16 instead of $14.50 as an example. In that case, in that second option, what you're doing is you're keeping your original position, your entire original position, but adjusting your stop loss to break even or break even plus the profit buffer. And then what you're looking to do is, as price moves to an additional key level in your favor, meaning above the 1.5 level threshold, the next key level here would be R2. The next one would be mid R2, R3. The next one after that is R3. Now, if you do have a contextual level that occurs after the minimum threshold that you've chosen to use for the key level regular trade threshold, then you can also use that as a waypoint if it occurs at least after the minimum 1.5 level move in your favor. In this case, the PMH level on this day is the only contextual level that happens to be occurring after the 1.5 level minimum required threshold. All these other ones are below here, so they do not apply. Then when price moves to the additional key level in your favor, whether it's a contextual level that qualifies or one of the other ones, then at that point you are going to have another decision to make, either adding more profit buffer to your original position or exiting 100% of your original position as it hits a further key level move in your favor, or scaling out and starting to take off contracts and then keep remaining runners. Now the third option is going to be applicable if you were trading 3 or more options. And this third option is a scaling out option in which you are going to sell and close out. You are going to close 60 to 90% of your original position at either the 1.5 level move or 2 level move in your favor on a regular trade, and then you're going to adjust your stop loss on the remaining runners that you're keeping to either break even or break even plus a profit buffer. Then you're following the same process of, as if price continues to move in your favor to additional key levels, then you would either adjust your stop loss further by adding additional profit buffer, or exit some of your remaining runners, or exit all of your remaining runners as each key level move in your favor. So with a minimum of three contracts, if you sold 2, that would be 66%. If you had 4 options and you sold 3, that would be 75%. If you had 5 options and sold 3 of them, that would be 60%. If you sold 4 of them, that's 80%. So you can see how it works is that basically you are closing out the majority of your position, the majority being defined as 60% up to 90% if you're going to do a scaling out strategy, and then you're going to manage your remaining runners. That way you're locking in profit on the majority of your original position at either the 1.5 level move minimum threshold or 2 level minimum ideal move in your favor, and then you are only de-risking your remaining runners by moving the stop loss to break even or break even plus a profit buffer, and then you're managing those runners to see if you're going to get a further move in your favor in the particular session. Okay, so here we have on the 10:34 a.m. candle here, we have the hit of the mid R1, R2 levels. So at this point here, the bid is $27.50 on the 73.10s. The bid is now $19.30 on the 73.20s, and the bid is now $15.50 on the 73.25. So at this point, if you're choosing to use the 1.5 level minimum threshold move on a regular day trade for your adjustment, and you would either close out 100% of these and you would have a greater profit than the scalp only, or you're adjusting your stop loss to break even or break even plus a profit buffer, or you're doing the scaling out strategy, closing out 60 to 90% of your positions here, and then managing remaining runners with moving your stop loss to break even or break even plus the profit buffer. Now at 10:38 a.m., we have a hit of the PMH level. So as we discussed, if you're choosing to use the 1.5 level minimum required move, then the next waypoint decision here would be at the PMH level, because it is occurring after the 1.5 level move. So if you did want to make an adjustment or close out all remaining positions here, the 73.10 is $28.70. The 73.20 is $20.30, and the 73.25 is $16.50. Now at 10:44 a.m. on this candle here, we do have a hit of the R2 level. That is now the minimum ideal 2-level move in your favor. As we talked about, in 80% of the sessions in a normal volatility environment in a normal year, The two-level extension from the BBKPL in either direction is going to be the extent of most moves that you'll see on SPX in about 80% of the sessions. What that actually means is that it's a good time to either be exiting 100% of your position, uh, whether it's your original position because you adjusted your stop loss and kept your original position by moving your stop loss to break even, or if you had remaining runners, you just need to be cognizant of the fact that 80% of the time or so, a two-level extension from the BBKPL in either direction is generally what you're going to see in about 80% of the sessions. Now, you don't really know if this is going to be an 80% session or a 20% session on any given day. However, the statistics show that on 80% of the sessions that it's going to be the extent of the move. So what that means is that if you want to see if you're going to end up being one of these sessions that ends up having a 3, 4, or 5, or 6 level move away from the BBKPL in your favor, that you're going to need to tighten up your stop loss on any remaining runners that you have past the two-level extension in your favor. So you can keep some remaining runners. Just keep in mind that if you're not going to exit everything at the two-level move in your favor, then you're going to keep remaining runners that at that point you need to add more profit buffer, and you may just want to reduce your position size down to just one remaining runner, one or two at the very most. So that's up to each individual trader to decide from themselves from use and practice, but that is just always something you have to keep in the back of your mind, that you are going against the odds after the two-level move, since 80% of the sessions are going to be limited to generally a two-level move extension above or below the bull bear KPL. So you just need to be more cognizant of your managing any remaining position after the two-level move has been reached. So on this two-level move here on the 10:44 a.m. candle, as you can see, it did slightly back off after hitting it. Nevertheless, the close of the candle here on the 73.10 is $33.70. On the 73.20s, it's $24.09, and on the 73.25s, it's $20.80. Now going back to the original position, we've gone from 14.5 to 33.7. So that is almost $2,000 profit on that. We've gone from 9.5 to 24.9. So that is approximately $1,500 profit on that. And from 7.5 to 20.8. So that is approximately $1,300 profit on that. Now, what about the lotto option strategy? How does this early session lotto option strategy differ from the regular key level strategy? Well, if you've seen some of our videos from a few months ago, we did in some of our videos go over a late session lotto option strategy, and that late session lotto option strategy is something that you can still employ. However, the late session lotto option strategy is different from the early session lotto option strategy. The late session lotto option strategy is for a window of time between 2 p.m. and 3:45 p.m. The SPX closes at 4 p.m. Eastern New York time. The late session lotto option window begins at 2 p.m. and runs all the way, as far as considering entries, all the way to 3:45 p.m. In the late session, a lotto option strategy has different rules than the early session lotto option strategy. One of the differences is the late session lotto option strategy is for only using a small portion of your session profits, up to 10% of your current session profits, towards any late session lotto options play. Now, we're not going to go over the late session lotto options strategy in this particular video. If you do want to see some of the videos that do show that late session lotto option strategy, you can email us at daytradinggps@gmail.com to request that we send you the various links to the various YouTube videos in which we went over that strategy, and you can take a look at how that differs from the early session lotto option strategy. The early session lotto option strategy is an alternative to using the standard key levels option strategy. So it's meant as an alternative to using one of these three option strikes. In how you are determining the strikes to use for this early session lotto option strategy is you are looking 1.5 to 2 levels away from the level that you're basing the trade on, and you are looking in the direction of the trade. So as opposed to here with the standard strategy, which was looking at the money play here based on the strike closest to the level that we're basing the trade on, then the first midpoint above, since this is a bullish trade, and the first full key level above. The lotto option strategy is looking to the targets for the regular trade. So the 1.5 level move and the 2 level move. So it's looking at the strikes closest to in this case, the mid R1, R2 and the the R2 level. So the mid R1, R2 level is 73.3469. So in this case, that is going to be the 73.35 strike. The R2 level is 73.4312, so that's going to be the 73.45 strike. Now, these differ from these others here in a couple different ways. So one way is because the cost is going to be significantly less. And the reason that these are lotto option strategies for early session versus the standard one is simply because of the cost. Because of the cost involved, you have a couple of different stop loss options that you have an additional stop loss, you have one additional stop loss option that you can use on the early session lotto option strategy that you're not going to be able to use with these. So the difference is when utilizing the standard key level option strategy strikes, you need to use either the tight stop loss or the standard stop loss, one or the other, for your stop loss on your initial entry when utilizing the standard key levels option strategy strikes. However, with the early session lotto option strategy, you can still use these tight or standard stop losses, just like you did with these. However, you have one additional stop loss option with the lotto option strategy, and that is that you can use no stop loss. And let me explain why I'm saying that. It really just comes down to the cost of these options versus the cost of these options here. With these options here, if for example, price started reversing and going down, and let's say, for example, it hits the standard stop loss, then in the case of these trades here, you're generally going to be looking at somewhere between a 35 to 60% loss on a hit of the standard stop loss. Now, those aren't exact numbers. It's going to vary based on the implied volatility of the options for that particular day, but somewhere within that range. You could say 35 to 40% to 60%. It's generally going to be a good range for if it hits the standard stop loss. And if it hits that standard stop loss early on, particularly in the morning part of the session as an example. So for example here, if you're paying $14.50, and let's just take a simple example of 50%. A 50% loss on this is going to be approximately $725. A 50% loss on this one here on $9.50, that's $950. That's going to be approximately $475. And on this one here that costs you $750, that's approximately $375. So that is your risk, if you want to look at it in numerical terms, your general risk that you're looking at here. Now you have to keep in mind that you're still using these levels, that you should not use a percentage of your entries on these. You still need to use the levels for the stop losses if you're going to employ the standard strategy, and there's a very good reason for that, as opposed to this other strategy. So with the standard stop loss strategy or the tight stop loss strategy, you're using the levels based. However, if you look at the early session lotto option strategy, you can still use either one of these two here for the stop loss, just like you did with these. However, with the lotto option strategy, you can also have the alternative of no stop loss, and the reason for that is simply the cost. Here you have a cost of $4.50. Now remember, here we had a potential risk of somewhere in the zone of 35 to 60% of what the entry was here. We were taking 50%, and that was 375 on this, 475 on this, and approximately 725 on this. Here you're paying $450 for this option. Here you're paying $2.55, $255 for this option. So again, you can still use these tight or standard stop loss on this if you prefer using a hard stop loss as a level on these early session lotto option strategies. However, you also have the option of utilizing no stop loss if you prefer to look at it that you're basically going to be having about the same amount of risk with either one of these. In the case of this, you have less risk overall than with any of these on this particular one. And with this particular one here, you have a little bit more risk overall than with this one if you're using no stop loss, but you still have either the same or less risk than with these two on hitting the standard stop loss. So that's just something that you have as an alternative only with the early session lotto option strategy because of the costs. Now let's see how these play out here as far as comparative speaking to these, which we'll move down here for now. We have an entry at $4.50. You're still entering on the same candle, 9:32 a.m. candle. As I said, you can still use the same stop loss levels if you prefer to do that over no stop loss with these. And then on this one, you have an entry price of $2.55, so that's $255. Now on the 934, excuse me, the 1024 hit here at the scalp level, now we have a bid of $7.20 on the 73.35s, and we have a bid of $3.70 on the 73.45s. Now what about the 10:34 a.m. hit when we hit mid R1, R2? On the 10:34 a.m. hit, now the bid is $9.20. Now we basically doubled this one from the cost of $4.50. This one is $4.70, not quite a double, but nearing a double here on this one. Now what about the PMH hit at 10:38 a.m.? Well, here it's $9.90 on the bid on this one, and the further side of the money is now $5.10. Now what about the R2 level hit, the 2-level minimum ideal move hit? Well, that occurs again on the 10:44 a.m. candle here, where it did back off after hitting it. And now we have a bid of $13.50. This started at $4.50, so this is a triple. This one is now $7.80. So again, we have a triple on this one here, $7.80, starting from $2.55. So the early session lotto option strategy can be an alternative to using this, especially if you prefer lower priced options and you prefer to keep your risk lower. Obviously, the move is going to have to happen in the early part of the session. Now, it can happen later in the session. However, there's more risk with it happening later in the session because these early session lotto option plays are based on the mid R1 and R2 level, in this case from a bullish trend off the BBKPL. So they're going to be 1.5 to 2 levels away. So you just have to keep in mind that if price is just hovering the one level move in your favor for the majority of the session, these are not going to perform as well if it just creeps up for the rest of the session and barely makes it to these towards the end of the session. So this is an early session lotto option strategy. What that primarily means is for employing early in the session, and you're looking for an exit early in the session as well, ideally before lunchtime. Okay, so that's going to wrap it up for today's video. We would like to close out the video with a couple of notes here. So one is, you may be wondering how these indicators and the daily key level strategy is working for people who have purchased the indicators and used the strategy on a daily basis. And so what we would like to do to close out the video is show you some of the feedback and user reviews that we've received from traders who have purchased the indicators and use them on a regular basis. Before we do that, if you are interested in purchasing the SPX Daily Key Levels Indicator and also our add-on indicators for the SPX, the VWAP, and the Ribbon Indicator, you can email us at daytradinggps@gmail.com to request a discount promo code to purchase either the SPX Daily Key Levels V3.0 indicator by itself, or for also purchasing the add-on indicator. So we have promo codes for each. And if you send us a request at daytradinggps@gmail.com for the promo codes, we will send you the promo codes for each of them. Also, we do also sell daily key levels indicators for futures, stocks, ETFs, Forex, cryptocurrencies, as well as the NASDAQ NDX index. We will have links to those daily key levels indicators in the pinned comment of this video. If you are also interested in purchasing one of those other daily key levels indicators, then you can also request a discount promo code. If you are requesting it for one of the other indicators, please indicate in your email which particular indicator that you are requesting the promo codes for. So our daily key levels indicators are as follows. So we have the SPX daily key levels indicator, the NASDAQ NDX index daily key levels indicator, the futures daily key levels indicator, the stocks ETFs daily key levels indicator, and then our Forex cryptocurrencies daily key levels indicator. All right, so before we show you the user reviews and feedback, we'd just like to take this time to thank you for watching this video today and also for supporting our channel. If you did like this video, we'd certainly appreciate it if you could hit the like button, as that helps us with the YouTube algorithm. It helps us support our channel. If you'd like to be notified when we've posted new session videos on any of our indicators or on any other trading topics, please hit the subscribe button and hit to be notified when you do subscribe of any new videos that we post. Thank you again, and we wish you much prosperity in all your future trading. Okay, so for those of you who might be wondering, well, how is this working for people that have purchased the daily key levels indicators? You can go to daytradinggps.com and look at the user reviews and feedback. We've just taken some of them here and highlighted parts of them, but we invite you to go to daytradinggps.com and look at the reviews and trader feedback on our various daily key levels indicators, including the SPX daily key levels indicator. Thank you.